In 2023, I quit dividend investing for good. And that was after spending more than a decade building a dividend portfolio. I used to own stocks like ExxonMobil, Imperial Tobacco, Rio Tinto, British Land, Realty Income. But as of June 2023, I sold every single one of them. And in this video, I'm going to walk through what led me to that decision, what I do instead now, and how I make as much income from my portfolio in a month as I used to do in an entire year. Now, if you don't know who I am, my name is El-Gorr. I own a company called Freeman Publications. We write about investing, we help people manage their money better. And so what I'm going to do is walk you through my entire thought process, building that portfolio, what changed and led me to sell out of my dividend positions, and the strategy I use now to generate income from my stocks. And this isn't about any sort of like magical market timing or speculative strategy. Instead, it's something pretty simple that takes me a handful of hours a week. So let's get into it. My journey of quitting dividend investing, and you can actually see on the screen here the final two sales of my last significant dividend positions in my personal portfolio. So Rio Tinto and Imperial brands. This was both on the UK market, although Rio Tinto is dual listed, and those were on the 14th of June 2023. So let me give you some background about my investing history and how I got to this stage in the first place. So my introduction to this whole investing universe was watching my grandfather, that's him right here, in case you couldn't tell, lose 85% of his portfolio in 6 months during the global financial crisis. His largest holding at the time, Citigroup, or Citibank as it was known back then, was down 94%. And so my entire introduction to this world was seeing someone who I respected so much and who was so successful in so many areas of life, essentially losing everything because of some poor advice and a couple of poor decisions on his end. And this, I believe this picture was the day before it all happened, or at least the day before he told me. So I just made my first investment at the time. I had bought 10 shares of McDonald's for around £400, which I think is about $500. And like I said, I wanted to know how someone so successful, my grandfather, in so many areas of life could get it so wrong in the markets. So I come into this field with a very high degree of risk aversion, because when your first introduction to something is all bad news, that tends to have a lasting effect. Because I remember the middle of 2008, the number one thing I remember from that time was all of these news articles and news stories about oil going up and up and up. It was about $140 a barrel at the peak. And it was, when are we going to hit $200 a barrel? And we've never gone close to that anytime since. But at the time, that was a realistic prediction. And so it was doom and gloom for about my first year of actually investing. And it's kind of like the older people watching this, your parents who grew up during the Depression. So people my age, that would be their grandparents and great-grandparents. It's ingrained in them, that sort of lifelong frugality and risk aversion. Very similar story to myself. If you come into this environment, this investing world, in a bear market and all you see is bad news, you're naturally going to be quite risk averse. And so when I start taking this more seriously, there's only one book that people recommend, which is this thing here, The Intelligent Investor. And I'll probably make another video just about this book and why I think it's a great book, but I also think it's a terrible book for people to be introduced to as their first investing book. But I read this book, I studied, and most of this book is talking about deep value investing, as we would call it now. The quantitative side is all about, these stocks with low PE ratios that have paid a dividend for the long term. And those were the kinds of companies I bought. And so it would be stocks with a low PE ratio, also a low price to book ratio. And it was primarily companies that paid a dividend because, as I had learned, if a company pays a dividend and it's done so for a long time, it's very stable. It's not going to go down 85% in 6 months or whatever it may be. And also, being from the UK many of our large cap and most well-known companies exhibit these traits. And if you're American and watching this, you might not be familiar with just how divergent the two markets are. The current PE of the FTSE 100, which is our major index, is 17.8, and that's historically pretty high actually. The past 5 years, it's averaged 10.4. And 10.4, the S&P 500 hasn't touched that since the global financial crisis. That's been our average over the past 5 years. Meanwhile, the S&P 500, current PE is around 26, and the past 5 years, and that's including the 2020, bear market's probably the wrong word, but like 2 months of chaos, and the 2022 bear market, the S&P 500 has averaged a PE of 21.4. And so I own these companies like Imperial Tobacco, like Rio Tinto, a couple of REITs in there. I own British Land for a while, Segro, which is a big warehouse REIT here in the UK and Europe. And the dividend payments weren't much, but the stock price was fairly stable. But as I dive deeper into this world, I do realize that I'm missing out on a decent amount of capital upside, because the issue with investing solely in the UK and in UK companies is there's not that much capital growth. In fact, I can think of one UK company today that I would consider like a growth stock by US and international metrics. And if you just want to simplify this, look at the performance of the FTSE over the past 15 years compared to the SPY, and it's night and day. And so what happens is, as I continue to invest, I start shifting. In around 2015, and this is 7-8 years in, I begin buying more US companies for growth potential. And it was ups and downs. I did really well in some semiconductor stuff, some SaaS companies, and of course I made a ton of mistakes as well. Canopy Growth, Beyond Meat, which I've actually made another video on about how I consider that my worst investment over the past decade. And so going into the pandemic, going into 2020, my portfolio is roughly 50-50 of high growth, but also some stable income payers. 2020 happens, and what I thought at the time was, okay, the dividend stuff will be fine. The high growth stuff I would expect to go down quite a lot. But what happened was, a lot of these companies that had paid reliable dividends for decades, some 50 plus years, they either started slashing their dividend payouts or suspended the dividend completely. And even in the UK, the big banks, some of which I'd owned for years, they were suspending their dividends, not from their own choice, but the regulators were making them suspend dividend payments because they wanted to ensure the health of the banks for the consumers and the people who had their deposits with those banks. So the shareholders got shafted, the consumers were held up. And I'm not going to go too deep into the morals and the ethics of that, because frankly, it's not really the point of this video, but just know that this can and does happen. So post 2020, I then see the divergence between the growth side of my portfolio and the income side of my portfolio. And the dividend, the income side was lagging massively. And even in just the past 3 years, if we look at some of the major dividend payers in the US, 3M cut the dividend 50%, Walgreens Boots a 47% cut last year. This year, they announced the suspension of the dividend. That's a 90-year streak that's ended. Intel cut the dividend by 65%. Leggett & Platt, 89%. AT&T did the spin-off with Warner Media, then cut their dividend. VF Corporation cut it by 30%. Xerox, company that's been around for 50, 60 years. This was the original growth stock. 50% dividend cut. Not just the US though, it's in the global market. BASF in Germany, 33% cut. Glencore, the mining company based in Switzerland, 75% cut. In Australia, Credit Corp, 46% cut. And then Imperial Tobacco and big names like BT, British Telecom here in the UK too, all have cut their dividends just in the last few years. You see here, Walgreens Boots, 48%. And then this was at the beginning of 2025. They completely suspended the dividend to essentially make sure the company is healthy for the next couple of years and doesn't go out of business. And so if you look at the SPY today, you look at the major indexes, great for capital upside, not so hot for dividends. And so when the yield of the SPY is hovering around 1%, and we've shifted from an environment here where the index is really dominated by tech companies, Amazon, Google, the Magnificent Seven, with, I believe, between the hyperscalers, it's $350 billion of capex just going into AI this year. That's $350 billion that isn't being paid out as a dividend and won't be paid out as a dividend anytime soon. This isn't like the 80s and 90s where it was these Exxons, these GEs of the world who they were massive, and then you could also rely on getting a decent dividend payout from them. So we ain't going to get Microsoft massively increasing the dividend anytime soon. We ain't going to get Google massively increasing the dividend soon, because so much of that excess cash is being spent on AI capex. And so gets to the middle of 2023 and I make a decision. I sell out of all of my dividend focused stocks. And so now in my long-term portfolio, all I have is positions for capital upside, plus the original McDonald's position that I have held since 2008. And like I said at the beginning, these were my last two sales, so Rio Tinto and Imperial brands. Mid-June 2023, I sold those, and so I no longer own any primary dividend payers in my long-term portfolio. But the flip side to this is you can't just live off unrealized capital gains. And I'm also not going to interrupt those capital gains by prematurely selling just to take the money and have the income from that. So there's got to be a middle ground, right? I don't want to just put the excess cash in a money market fund because 5% a year really doesn't do anything for me. And naturally, I needed a solution for the income side of my portfolio. And so here's what I do now. So instead of really just settling for 3% annual dividends, now from the income side of my portfolio, I make roughly 3% a month. And this is actually a lot more conservative of a strategy than you would think. And what that translates as, if you've got a 100K portfolio, the old approach, you're looking at $5,000 a year if you're lucky. If you've got some higher yield stuff in there, sort of the JEPIs, the JEPQs, you're looking at just over $7,000 a year. But this new approach, you're looking at $36,000 a year. You're almost making as much in a month as you were in a year with the old approach. And so what was the new strategy? Quite simply, it was the wheel, which is a strategy I've been trading now since the beginning of 2019. And then the last 3 years or so, I've taken it really seriously. So if you're not familiar with what the wheel is, I'll talk more about that later on. But essentially, you're selling options on companies that you would like to own and collecting income in the meantime. And so now I don't need these companies to pay me dividends. So it's not like you have to buy a stock, then wait 2 or 3 months for the payout. I look at this as being able to create my own dividends. I call this CYOD, create your own dividends. So you generate income on demand whenever you want, wherever you want. And this is really, really cool. And allow me to explain the upside, but also how it works. So in the last 3 years, these have been my results doing this strategy. 2024, I did 36.5%. 2023, I did 33.8%. 2022, in a much tougher year, I came out 8% ahead. And that might not seem like a lot on the surface, but when the S&P was down 18% that year, I ain't complaining. More importantly than that, because this is all percentages, it doesn't mean anything. The income I make from the wheel strategy, it pays my mortgage now, pays my utilities every month, pays for 3 or 4 vacations for me and my family a year. Whereas the dividend income I was getting was covering a couple of date nights a month, maybe one of my bills. So yeah, it was passive, but it really wasn't moving the needle enough in my own life. And to really demonstrate this, I want to actually do a side-by-side comparison. So one of the stocks that I sold was Rio Tinto. I sold 100 shares of it. And right now, Rio Tinto pays a dividend of $4.43. I do apologize. $4.34 per share. Roughly a 7% yield as of today. Now, I used to own 100 shares. The next payout date from today, I'm recording this in mid-February, is in April. And Rio Tinto is actually only a biannual payer because it's actually a British company. So it's $257 is going to be the payout in April, and then another $176 is going to be due in September. For the same money invested, so it's about $6,000, I can sell one options contract on Rio, the stock. And if I sell those contracts at roughly where the stock's trading at today, that's $197 in the account for a 15-day trade. And the cool thing is when you sell options, you get paid up front. You don't have to wait for any dividend payout. And that's exactly what I did. So this is one cash secured put option on Rio Tinto. You can see here, you're getting paid $1.97 per share. Because one options contract is 100 shares, that's $197. It expires in 15 days from when I place the trade. And like I said, you get paid $1.97 per share because one contract is 100 shares. The more mathematically inclined of you might be thinking, well, that's less than you would have got in dividends. So like, what's the point? Well, the main difference is this trade ends in 15 days. So I can just do the trade every month. And so if you think about it, if a 15-day trade is going to pay you $200, a 30-day trade is going to pay you a little bit more. So I've actually been conservative here and I've said $300. So if you did this trade every single month and got $300 from these shares of Rio Tinto, over a 7-month period, so I've done the whole dividend cycle for the stock. It's actually an 8-month period, I do apologize. The income from just buying and holding the 100 shares is $434. The income from running the wheel on the same stock is $2,262. So you're making 6x the income, 5.5x the income from running the wheel as opposed to just buying and holding for the dividends. And if you think about it, the risk reward here is going to be the same, because if you're buying and holding the shares, you are going to be beholden to the fluctuations of the stock. It's the same with selling options. You're still beholden to the same fluctuations. So the way I've always looked at it is there's no additional risk that you're taking on. All it is you're actually spreading the risk because it gives you more flexibility. Like let's say, for example, I don't like the look of Rio Tinto's chart anymore. Well, now I can just choose a different stock. Whereas if I'm actually holding the shares, it's like I have to then sell the shares short term to buy something else. Whereas this, because there's no shares being owned with the put option, I can use that buying power differently. And if this is now getting a little bit in depth, a little bit complicated, don't worry, because I've written a book on the subject. It's available on Amazon and all other good bookstores. And there's also a YouTube video, which I'll link down below or on the side here somewhere, of me walking through this strategy step by step and how every single aspect of it works, including some live trades so you can actually see the mechanics for yourself. So that's going to be on the screen as well. And yeah, really that's my journey of going from a dividend focused investor to then quitting dividend investing entirely, and now what I do instead for the income portion of my portfolio. So I hope you enjoyed this video, and I will see you in the next one.